I said, you can't call these events to within a few months. And at another point, I said, history says that when you reach this level of craziness, the market tends to break within a few months rather than a few years. And I think with hindsight, the market started to get distinctly weaker about 10 months after we talked. So that's a few months plus a little bit. And this has been exactly how the great bubbles have broken. The blue chips, the S&P 500, have kept strong right up to the last second, and wave after wave of the stocks that had made the real running peel off and drop. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85%. They had crushed the market. The really classic example of this is the Russell 2000, which is stock number 1001 to 3000. They're multi-billion-dollar companies. They're a serious enterprise. In the last year, they are down. They have not made any money at all. The S&P's made 23%. The Russell 2000 is meant to go up about 1.2 times the market. In a bull market like you're saying there was, it should have been up about 30%. It wasn't even up recently. This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. 2000, you may remember, the growth stocks peeled off and were down 50%. The S&P was flat, which meant the remaining 70% had risen 20%. This is an enormous divergence, and it happens on the upside for the blue chips. So this is it's almost eerily classic. And we have been checking off this list all year. When I sat down a year ago, we had seen the accelerating phase that you need in a bubble. That had taken place last year with the NASDAQ up over 100 from the low, but also up 58% from December of 2019. So even granted that COVID decline, it was a hell of a year. It was a year of acceleration. And the NASDAQ has started to weaken relative to the blue chips. The Russell has started to weaken much more so even than NASDAQ. I would say clearly more. I did freely admit, not in our conversation, but elsewhere, that I wasn't quite as certain about this bubble a year ago as I had been about the tech bubble of 2000, or as I had been in Japan, or as I had been in the housing bubble of 2007. I used to think then in terms of near certainties. This time I felt highly likely, but perhaps not nearly certain. Today, I feel it is just about nearly certain now. I think the crazy behavior, the peak of crazy behavior, is behind us. I really do. I think we're now in the buy the dip mode, which the super bubbles specialize in. You don't have 2 years of buying frenzy dying overnight typically. So even in 1929, you had some magnificent rallies. And buy the dip is the watchword of practically every brokerage house out there. And it always is. You never, almost never, have a major brokerage house say, the game's over, guys, duck. It doesn't happen. The commercial imperative is overwhelming to stay bullish. It's how you make money. The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level. And of course, it declined very quickly, 50% in 1929. It declined 50% in 3 years in 2000. And the housing market, which was another great American super bubble, went all the way back to trend in 3 years. As I said a year ago, I think they'll do pretty well by selling. I'm sympathetic to how difficult it is to get out entirely out of equities. And I would point out, as I did last year, that there are less overpriced parts of the equity market around the world. In fact, everywhere is less overpriced than the US. The US is the peak of this bubble as it was in 2000. And what it meant then is what it will mean today, and that is the US will decline a whole lot more than the rest. It's also true that the value end of the spectrum, as opposed to the growth end, is about as cheap as it gets. So if you can combine those by buying value stocks outside the US, I would say particularly emerging markets, but there's quite a few countries, Japan, the UK, where the markets are. If they're overpriced, they're only moderately overpriced. The US is not moderately overpriced. It is shockingly overpriced. Personally, as opposed to GMO, in the foundation we have for the protection of the environment, we are indeed short a decent amount of Russell 2000s. So we haven't been hurt in the last year, which is amazing. We're also short about half as much again as in the NASDAQ, which did hurt us, but not sensationally. And the point there is a lot of our money is in venture capital. That's very growthy. We need some hedging. And if we weren't exposed to a large amount of growth stocks, I suspect we would skip the hedging. We would skip going short. In any case, I would never short an individual name. I would only short a broad index. And the indices I would short, if I was up for that, would be the Russell 2000, because they have a high density of flaky companies that aren't making any money, and the NASDAQ, which also has a high percentage of companies not making any earnings at all. What makes the NASDAQ more complicated is that it has these remarkable FANG stocks in it. And that makes life complicated. At the top, even though they feel the commercial imperative to be bullish, they're thinking to themselves, but my God, the market looks expensive. So I'm darned if I'm going to dance over the edge in Puma Tech in 2000. I'm going to dance over the edge in Coca-Cola in 1929 or Coca-Cola in 2000. And it works. When the end comes, it is always better to have danced off the cliff with the great blue chips than with the specs. And the defining feature of the great bubbles, the super bubbles, is that towards the end, even on the upside, as the S&P and the blue chips go up, the super specs that have led the market for the previous few years start to go down. They don't even underperform. They get the sign wrong. Today, as we sit, well over 40% of every stock on the NASDAQ is down over 50% from its high. So this divergence, which is very rare, occurred in 1929, occurred in 1972 in front of a good bear market, occurred in 2000, and is once again has started since about the spring of last year. What I would do is make sure you have some cash reserves. There may be some great buying opportunities in the next couple of years. Secondly, I would try and avoid US stocks. If you have to own some, I would own high quality. They always do better in a serious shakeup. And this has the ability, as all bubbles breaking do, to cause a credit crisis somewhere along the line. It may not, but it well may. And so blue chips are the way to go. Avoid debt, avoid specs. And to the extent you can, avoid the US. It's the most overpriced market. Real estate is overpriced everywhere in the world. But the stock markets outside the US are curiously not that bad. they're in a bull market, they're overpriced mostly, but they're only normally overpriced. And there are a few cheap countries. Japan looks pretty cheap, the UK not so bad. And if you looked at emerging markets, you would find some cheaper countries there too. And within the countries, if you looked for the cheap stocks, growth versus value, growth has had an unprecedented decade. It is probably the turn for cheap stocks again. So emphasize cheap countries, cheap stocks, avoid the US. And if you have to buy the US, for heaven's sake, pick the quality stocks and have a cash reserve.